We're thrilled to death to have you here. This is the very first Pickler Breakfast Club, something that we've talked about for quite some time, and we're very excited to kick it off today with such a great crowd, and we really appreciate everybody taking some time to get here. I do want to tell you that when we're going to begin with some remarks from our featured speaker, Brad McMillan, and but I do encourage you, if you have questions, everybody on your table has some note cards on there, and there's some pens, and if you have questions that you would like to ask Brad to make it easy, then just write in your question, and then just at some point just kind of hold it up or whatever, and we will come around and pick them up whenever you're ready for that. But we are thrilled to have you. This is designed to be an opportunity for you to ask some of the great questions of really someone I believe is one of the leading minds on Wall Street. So let me tell you a little bit about Brad. Brad is a CFA and a CFP. He is the managing principal, the chief economist, and special advisor at Commonwealth Financial Network. And he's working with our wealth and investment management leadership and advisors all over the country. Until the start of this year, he actually was the head of wealth management and was the chief investment officer. He has now moved into this other leadership role. He received his BA from Dartmouth. He also received an MS from MIT and an MS from Boston College. So pretty good academics. He's worked, done a lot of different things. He's been a real estate developer. He's been a consultant. He's been a lender. He served as an investment analyst, a manager, and a consultant, and also as a startup executive. So Brad certainly can look at things from a number of different points of view. Professional qualifications, he has designated membership in the Appraisal Institute, the CFA Institute, and the CAIA Association. And he also, as I mentioned earlier, is a certified financial planner practitioner. And obviously, Brad is someone who has spent the past 20 years speaking all around the country on economic and market issues. Ladies and gentlemen, let's give a great cordial welcome to Brad McMillan.
Thank you very much, David.
You see the jobs numbers, and they come out, and people say, oh, so many jobs were created, so many jobs were not created, this is a problem, politicians, yada, yada, yada. That's why that matters. Because for the economy to work, people have to have money to spend. For people to have money to spend, they have to either work or have worked. Look at jobs. You might think that was common sense, wouldn't you? More people working is better. I think it is common sense. But it tends to get lost in the discussion. Because then you have to start moving into the details. How many jobs need to be created? Because there's more people coming in. There's college graduates. There's high school graduates coming into the labor force. But then that's offset by people retiring, i.e. us, most of the people in this room. And then there, of course, is how many people are coming into the country from outside or leaving the country to go back outside. So you have to look at those job creation numbers, and the bottom line is, if they're above about 50,000 a month, we're doing okay. That's the number you need to keep an eye on. More is better, but 50,000 a month is kind of the break point. So what does that mean for today? What does that mean for today? We've actually seen job growth about that level, and it's ticking up. It is ticking up. And in fact, given the fact that the labor force is growing more slowly nowadays, that is even better than it looks. So from a jobs perspective, I'm not actually that worried about the economy. I'm not that worried about the economy. That's going to be a theme that we're going to be talking about for the rest of this, which is, at some point, yes, we're going to get in trouble. At some point, we're going to have a recession. But generally speaking, with the economy, we have visibility for about 6 months. And right now, jobs look pretty good for the next 6 months or so. It's really the biggest piece, because as I said, that's 2/3 of the economy. That's not the only piece. Okay, you got a job. You're working. That's good, right? You gonna go spend money? Maybe. How much money are you gonna spend? That's gonna depend on how you feel, doesn't it? If everything looks great, you're going to go out and buy a new boat. If everything looks terrible, you're going to try and sell that boat. But nobody's going to buy it. Trust me, my dad's bought and sold a lot of boats. I know this. And that's the next thing, because that is the other key determinant of consumer spending, which is how people feel. How do we know how people feel? Well, they ask them. Pretty simple, right? And there's two surveys. One is the Conference Board survey, and one is the University of Michigan survey. Has anybody seen the headlines about how consumer sentiment is at close to all-time lows? Nobody else reads the same papers I do. Okay. But that's the Michigan survey. And what's interesting about the Michigan survey is if you go back historically, A, it's more influenced by politics vibes than anything else. And B, it doesn't correlate well with how the economy reacts. In other words, it's an interesting data point, but it's not actually a useful one, which actually describes quite a bit of economic data. The Conference Board survey, on the other hand, is a much better predictor of how the economy is going to perform. And it's doing okay. But even there we have a problem. What does it mean that the Conference Board indicator is at 120? I don't know. No one does. It's kind of a meaningless number. So what does matter? What matters is how that's changed over the past year. And if it's dropped by about 20%, you got a recession coming. We're not there. People are still working. People are still making money. And people are still feeling pretty good. Despite the politics. Despite everything that's going on around the world. Despite the war. We have over 2/3 of the economy that is still pretty solid. And looks likely to stay that way for the next 6 months. We don't get recessions in that situation. So I'm feeling pretty good about that. But that's not all the news that's worth cheering about. Okay, cheering's overstating it. How about a gentle smile? Can we do a gentle smile? There we go. Thank you. When you look at business investment, because in order to sell things to us, in order to provide services, businesses have to invest. Yes, they have to hire, but they also have to build buildings. They have to buy trucks. They have to buy copiers. They have to hire financial advisors. All the important stuff. And businesses are investing like crazy. You probably read about the AI boom, right? And there's a lot of headlines about chips. There's a lot of headlines about semiconductors. And that matters. That's important. That's not what's driving this. What's driving this is wiring. What's driving this is construction. What's driving this is concrete and power supplies. That's what's driving this. We have an economy-wide boom in business investment and manufacturing. Now, that's a relatively small part of the economy. That's one slice of the pizza. But that is one more piece that, along with the consumer, is going to continue to drive the economy. The last biggest piece, of course, is the government spending. Wow, government spending. There's a lot I could say on government spending. I'm sure you all want to yell at me about whatever your particular take on that is. Trust me, I agree with you. All of you. But the advantage of running an enormous deficit, and there is one advantage, it's enormously stimulative. It helps drive the economy forward. Will there be a cost? Of course there will. That's another talk. But for the next 6 months or so, this is one more tailwind for the economy. And this is something that I think kind of gets lost in a lot of the details, which is that everything is pushing in the right direction for the economy. And it's likely going to continue to do so for most of the rest of the year. That's not a bad thing. That doesn't mean it all ends at the end of the year. We'll be looking again in 3 months and 6 months, and we'll have 6 months visibility then. But for right now, I'm actually probably as confident as I've been for a while for the economy. So that's part one. What does that mean for the market? When do we get bear markets? We get bear markets when the stock market goes down 20%. The more interesting question is, are we going to get a bear market? And the answer is yes, we are. The even more interesting question is when? And to that, the answer is, I don't know. But I can tell you a couple of things. If you go back over the past 50, 70 years, we get fairly regular pullbacks, some 10%, some 20%, but they don't tend to last. When do the bad bear markets come? They tend to come in the context of a bunch of different things happening at once, and the biggest one is a recession. Will we get a bear market at some point? Absolutely. Will we get a grizzly bear market? Only if we get a recession in the context of everything else that is going on. As I say, I don't think we're going to get a recession over the next 6 months. So I'm less concerned about a sudden, sustained drop in stock prices. Will we see normal volatility? Absolutely. But I think there is some cushion there because of the strength of the economy. And again, there's some more good news out there. Because when you look at what drives the stock market's value, there's really only two things you need to look at. Okay? And again, remember, for the economy itself, we're looking at jobs, we're looking at consumer confidence, we're looking at business investment, business confidence. Those are the three things you got to look at. Here are the two things you got to look at for the market. One is earnings. When you buy stock, essentially you're buying a claim on a company's earnings. They owe you that money. The more money they make, the more your claim is worth. So if earnings are going up, that gives us a real cushion. That gives us a real driver for the stock market. And earnings are going up. Why are they going up? Well, they're going up because of business investment. They're going up because consumers are spending. All you folks are going out shopping, again, thank you. If you're not going out and shopping, get out there and shop. And in fact, earnings are doing better than expected. Why is that? It's because the economy is getting more efficient. AI. It's real. We're already seeing companies getting more efficient. We're already seeing costs going down, margins going up. We are already seeing this. There's a famous economics quotation from the late 1990s that said, we're seeing the internet everywhere except in the productivity statistics. Guess what? We're seeing AI in the productivity statistics already. Why do you care? Because that directly supports the second thing that drives stock market values, which is how much investors are willing to pay for those earnings. And there's a couple of variables there, but the biggest ones are interest rates and stock and profit margins. Now, interest rates are going to do what they're going to do. I know there's some questions prepared about this. We'll be talking about that, so I won't get into it now. But interest rates are going to do what they're going to do. But the real question is valuations. How much are you willing to spend? How much are you willing to pay for a dollar of earnings? And what's interesting is margins have been rising in the past couple of decades, and valuations have been going up as well. Because those earnings are more sustainable, more defensible, and less at risk. In other words, valuations, the better they are, the better the earnings better be. And AI gives us another moat to protect those earnings. So again, this is something, it's not a guarantee. We're certainly going to see volatility. But there are a bunch of different tailwinds, the economy, valuations, business efficiency, through AI, and through everything else that are all pushing in the same direction. We're still in a good place. Things are going pretty well. And when we talk about all of the risks that are out there, you know, yes, I follow the news, Strait of Hormuz, Ukraine, everything else. There are real risks. There are real things to worry about and things that can go wrong. And I can absolutely guarantee you things will go wrong. And yet, things have always gone wrong. Anybody remember the pandemic? Everybody remember 2008? Things blowing up is usual. Things blowing up is usual. I am 60 years old. Gosh, there's war in the Middle East. When have I seen this before? My whole life. Exactly. You know, oh, Europe is arguing with the U.S. When have I seen this before? My whole life. I actually gave a talk a number of years ago, and there were some slides on there, and it was basically, I went back over the preceding 10 years, and there were a couple of things, and I just, you know, we were at peak oil. Oil was going to be $200 a barrel, and it was going to be too expensive, and it was going to be the end of the world. Remember that? Goldman Sachs, peak oil? And then 5 years later, oil was too cheap. It was going to destroy the U.S. economy. And then interest rates were too low because it was going to destroy the financial system. And interest rates were too high because it was going to destroy the housing market. And you have seen over and over again people like me standing up here saying, well, this surely means the end of the world. We're still here. Stock market's at record levels. The other main worry that people seem to have is politics. And as a citizen, as a voter, as an informed American, I have my own opinions. And they are exactly the same as yours. All of you. But as an economist, as an investor, as someone who has been the chief investment officer of a national organization, I can remember when Barack Obama was elected. And I had a lot of people telling me they were going to sell everything and move abroad because the U.S. economy was doomed. And then I remember talking to people when Donald Trump was elected for the first time. Different set of people. And they were going to sell everything and leave the country because the U.S. was doomed. Back to the first set of people when Biden was elected. The ones that hadn't left. And then back to the second set of people again when Trump was elected again. And yet, here we are. They call me Eeyore at work. And I'm not saying it's not deserved, and I know Quinn and I are on the same page with this. And that is our job. It is our job to think about what can go wrong. You want me to scare the heck out of you? Trust me, I can scare the heck out of you. You're going to go home and cry tonight. But that's not actually what I believe. I think we're in a pretty good place. Will we have troubles? We have issues? We have pullbacks? Absolutely. I think we're in a good place. I think there's a lot of opportunities ahead. And when things go wrong, well, call court. And with that, I'm happy to sit down with my colleagues here and take whatever questions you have. Thank you very much.
Brad does have within the Commonwealth world. We have affectionately referred to him as Eeyore for years, but I've had the honor of hearing Brad for many, many years, and that's one of the reasons why we wanted to bring him today. But we do want to ask some specific questions, and I want to go back to what you were saying about Washington. Is Wall Street ignoring Washington? And if so, is there a good reason to ignore Washington, or are there dangers of ignoring Washington?
Here's the thing. There is an assumption that everything is going to be okay. I think to some extent, Wall Street is tuning out the noise. And that has been a very successful strategy for the past several decades, as I said. Now, that being the case, there are reasons to believe that we are going to hit some unusual bumps in the reasonably near future. The deficit and the debt are one of them. Potential knock-on effects of the Strait of Hormuz are another. In other words, yeah, I think that Wall Street will be paying attention to politics at some point in the next couple of years, and probably not in a positive way. However, that said, what we have seen over and over again in the past is Washington will ignore problems until the pain of the problem is greater than the pain of the solution. And that's actually the best way to think of this. Right now, we know what to do. There's I forget who said it. Somebody said, everybody in Washington knows what has to be done. What nobody knows is how to get reelected once they've done it. And that's why nothing happens. So, but the upside of that is once the pain of the problem becomes greater than the pain of the solution, it will get done. Winston Churchill, one of my heroes, said it best. He said, you know, you can always count on the Americans to do the right thing after they've tried everything else.
I think our clients have heard that a lot. David and I say that a lot.
So, great minds think alike.
Absolutely.
So,
You know, I think this is a great next question. Here we are in Memphis, home of the king of rock and roll, and but we've had for many, many years another king, King Dollar. And so what is your view on cryptocurrency and the dollar's put in a position as a reserve currency and the threats to the dollar?
So those are two very different issues. Those are two very different issues. Let's start with crypto. I have been, I would say, agnostic about crypto all along. The use case I see for crypto is basically terrorism and crime. But at this point, I think Bitcoin has faked it until it made it. I think Bitcoin's around for the long haul. That said, the easy money has been made. You know, you've seen Bitcoin trading in a range somewhere between 65 and 100. It's acting like gold. Because the thing is, a mature safety asset should trade in a range and only break out when there's a threat to the system itself. So that being the case, I think Bitcoin in particular is now kind of a gold equivalent, but in my opinion, inferior to gold. Because gold, at least, you can wear. If the system goes down, the system goes down, Bitcoin goes away. So I think gold is probably a more effective systemic risk hedge. And we've actually seen that in the behavior of those assets recently. So that's not just me guessing. So King Dollar. I have spent the past 20 years laughing at the idea that the dollar could be dethroned. I'm not laughing anymore. And there's a couple of reasons for that. First of all, one of the implicit underlying factors in the U.S. dollar's status as a reserve currency was the fact that the U.S. guaranteed the global trading system. That's what the U.S. Navy was for. That's no longer the case. If you look at the Strait of Hormuz, that is the biggest knock-on effect over the next decade or so. Second of all, the increase in globalization, including the U.S., meant that everybody traded in dollars because everybody traded in dollars. The U.S., the global trading system is continuing to integrate, but outside of the U.S. So consequently, there's going to be fewer dollars in the system. They're going to have to start using other currencies. Third of all, you have other economies stepping up and looking more stable as geopolitical entities. I'm thinking of the Eurozone in particular, but also Japan. Both of those now, the euro now offers a much more attractive geopolitical risk option than the dollar. Now, is this a today problem? It's not a today problem. But if you had asked me 5 years ago, I would have said it was a 30-year problem. Now maybe it's a 20-year problem, maybe a 10. And again, that doesn't mean the dollar all of a sudden goes away. You know, you're getting all of these mailers saying everything's got to be, you know, sell everything, the dollar's collapsing, yada, yada, yada. And they all want to sell you a newsletter. And interestingly, they all want dollars for that newsletter, which has always kind of amused me. So it's something to keep an eye on. But again, the way to address that is to diversify. if you're holding assets, if you're holding international assets, international stocks, you'll have a built-in hedge against that. U.S. assets are going to be priced in dollars, and even if the dollar were to become less important, we're still one of the most self-centered economies in the world. The impact would be quite limited. But yeah, that is my concern about that.
Okay. When Iran is settled, no more war, Hormuz is wide open, when will the USA get back to normal?
That's a great question. Thanks for asking that question. Next question. No, looking strictly from an energy perspective, I'm not even sure, after everything we've been through over the past 20 years, I'm not sure I would recognize normal if I saw it. From an energy perspective, things are probably going to get worse before they get better. There was about 2 to 4 weeks of tanker supply on the oceans when the strait was shut down. Right now, that started the last of the tankers started getting in. We're working down stocks, and we're probably going to hit a supply break. I don't want to use the word crisis because that would be wrong. In the next month or two. And it's not going to be a question of price. It's going to be a question of availability. Again, not in the U.S., but in a lot of other areas of the world. If we open the strait tomorrow, it would probably take about 6 months are the best estimates of what I've seen. So I think we're probably looking at 6 months plus until the time we actually open the strait before things really start to normalize on the energy front. And again, there's a lot of give in that, but it's something around there.
Okay, this one's on home mortgage loans. Is there hope of those rates falling in the next year? What do you consider a healthy 25-year retirement cushion and withdrawal rate? I've heard a lot of podcasts saying the 4% rule, but are we really closer to 6 or 7%?
Mortgage rates, interest rates, given the recent inflation data, I think we're probably going to see the 10-year U.S. Treasury security, which is what mortgage rates price off of, in the same range or even up a bit over the next year. So if you're looking to buy, I wouldn't hold off in the hopes that mortgages are going to go down. Longer term, I think there are a number of structural features which are going to keep rates higher than they've been. In other words, I don't think we're going to see rates going back to where they were. And I think if I was going to bet one way or the other, they're going to go higher. So, that's kind of the interest rate thing. What was the other question? I'm sorry.
Withdrawal rate.
Withdrawal rate. Generally speaking, I personally am putting my planning on 4%. There is research out there that says you can do it more. I haven't seen as high as 6, but I have seen it as high as 5. And again, that's the problem I have with that is it's a mistake you won't know you're making until you're too old to do anything about it. It's like I tell my wife, we could retire tomorrow if we died the next day. So for some reason, that doesn't seem to comfort her. So, I personally would stick closer to the 4. If you need more than that, I don't think you're necessarily shooting yourself in the head, but I think cautious is better. There's no such thing as old age scholarships. So
Let's go back to AI. Question is, there are indications of a white-collar job crisis caused by AI. You talked about the fact we're beginning to see some signs of productivity gains, but what does that mean in terms of the jobs front, which you talked about as one of the major issues?
And that's exactly right. In the short term, I do think it's positive. In the longer term, and even in the medium term, that is one of the big things we're going to have to wrestle with as a society is job destruction. And we're already seeing this kind of at the lower levels. There's a lot of companies that simply aren't hiring nearly as many junior people. And the problem there is, of course, in 10 years, we're not going to have senior people because we didn't hire the junior ones to start off with. 6 months ago, I would have said, based on what I had seen and everything, AI, I'm not worried about it. Now I've had a chance to work on AI with some projects, and I'm glad I'm 60 years old. You know, it's really remarkable how far it's come, and it's only accelerating. And I think that's probably going to be one of the biggest issues we face going forward is what does we've seen a lot of the destruction of manual work. You know, agriculture lost 99% of its employment, and most of them went to manufacturing, and manufacturing is now being significantly downside, and most of them went to cognitive labor. And now we're seeing cognitive labor being automated. I'm not sure where people are going to go. And that is something that over the next 5 to 10 years is probably the biggest problem I see. Again, it's not a this year problem. It's probably not a next year problem. 3 to 5 is when the rubber's going to hit the road. And I don't have a good answer. I'm sorry.
Let me just add something to that. One of the interesting statistics that I heard recently, not statistic, but predictions that I heard recently was actually that the real tipping point for AI is going to be when there is a combination of the AI that we're already familiar with processing capacity sufficient to interpret our speech, consider what we've asked, and give us a spoken answer back. Right now, we still have to type in.
No, we're there. We're there.
Cheap.
Yep,
Cheap.
$20 a month.
With like the companion.
Claude.
Claude?
Claude.
Well, then we're screwed, everybody.
Oh, thank you. The double Eeyores. We got to worry about this. Have tariffs caused the pain that many predicted?
What's that?
Have tariffs caused the pain that many predicted?
Have tariffs caused the pain many predicted? Yes and no. And I say yes in the sense that they have had a negative effect on profits. You can see this very clearly showing up in the corporate numbers. And no in the sense that that has not been passed along to consumers. But that is starting to happen, or was starting to happen, I should say. So it's a question of where the damage shows up. Right now, that profit damage has been largely offset by a bunch of other positive factors. I mean, arguably, we might have had the stock market even higher than it is. But there have been effects. It wasn't, the economists weren't imagining it, but the economy has been more resilient. So it's a little bit of both.
This is a really interesting question from one of our guests here. It says, when the same set of circumstances, such as the price of oil going up, causes the market to go up or go down, what affects the decision and who makes these decisions? Are they influenced by large retirement fund managers or specific individuals? And so these are different circumstances that may cause different outcomes.
That's a great question. And I mean, when you look at it, I would love to believe that there's somebody out there making decisions, because the possibility would then exist that that person could make good decisions. I haven't seen a lot of evidence for that. When you look at, for example, the oil market, right now you have the Chinese, the Indians, the Russians, the U.S. companies, and they are all trading in these globally diversified markets 24/7 in trillions and tens of trillions of dollars. I'm not sure who has the power to influence that. The Saudis do, certainly. They can shut it off. You know, but in terms of broader economic effects, if I said earlier about, you know, the reaction is the price of oil goes up, it's the end of the world. The price of oil goes down, it's the end of the world. Nobody knows what's going to happen. This is an enormously complex system. And that's why I say we have visibility for probably the next 6 months. There are a lot of organizations that would like to influence things and that do their best, the U.S. government being one of the biggest of those. But private organizations, there's just no evidence of it. And like I say, I would actually not be opposed to it, because then they might actually do good things. But we haven't seen any evidence of that either.
Okay. There's been a lot of talk lately about insider trading. There's also been, speaking in terms of who's making the decisions, poly market, the predictive market, stuff like that. There's been a lot of talk about insider trading on poly market in the stock market. What do you think the effect of the economy is on what could be bigger insider trading than what we've seen, at least in recent past?
Without taking an opinion on the political aspects of this, because I'm a coward, one of the things that has made financial markets work is an essential belief that they are fair, that nobody is ripping anybody else off, that you can actually invest in the markets without having some insider take your money. That's been one of the major drivers of U.S. success, quite frankly. So, you know, there is a fairly wide range of concerns around this. But again, we've seen this before. We saw this in the 1920s, and reforms came in. So I could say, on the one hand, yes, there do seem to be very serious abuses occurring. And what I would fully expect is sometime in the next 10 years, the next administration or the one after that will go in and re-empower the SEC and everything else. Is it a problem? Quite possibly. Is it a solvable problem? Yes, because we've done it before.
Is retirement a realistic objective for people today, or is it becoming a pipe dream for too many Americans?
Well, it depends on what you mean by retirement. It depends on what you mean by people today. I mean, I still believe that, and this is a belief, I can't prove it, but it's, I think, a pretty well-founded belief, and I got a lot of evidence for it, that markets will continue to grow, the economy will continue to grow, we'll continue to have opportunities, new companies will be created, wealth will be created, and if you save and invest over time, you will be better off than if you don't. I mean, I was talking with David about this last night. I said, you know, my mother was a social worker. She spent her life helping people. And as I've gotten older, I realized I like to do two things. I like to solve problems, and I like to help people. Oh, I've also got a family to take care of. So I like to make money. And this job actually allows me to do both. And I don't see that changing, because the financial markets are set up for growth for the average person. If you save, if you invest, you will do well over time. And that's the only way to do well over time. Do I think it's a pipe dream? I don't. I just think it's going to take time.
We're going to pivot a little bit, and this is a question that I decided I would throw to Brad. Last weekend, I don't know if anybody in here follows any of the mixed martial arts, but last weekend we had two former champions that gathered in the ring, Ronda Rousey and Gina Carano, and I think the match lasted 17 seconds. But it made me think that we have another heavyweight battle that's about to happen because the Senate has just confirmed Kevin Warsh as the new chairman of the Fed. And he's coming into a very unique situation because for one of the first time I can remember, we have a Federal Reserve chairman in Jay Powell who is not leaving. And so when we think about the dynamics of Kevin Warsh as the new Fed chairman and Jay Powell there and the ongoing conflict with President Trump, what does this mean for Fed independence, monetary policy, and ultimately the impact on the market or the economy?
Ronda Rousey, huh? I'm having a tough time picturing either of them in the octagon there, but okay, whatever. I guess you have to look at it from the perspective, well, I would probably look at it from the perspective of Warsh, then the perspective of Powell, and then the perspective of the institution. And I think at this point, Warsh is coming in. He very clearly has the political winds at his back. Over time, he will be getting more and more appointees appointed by President Trump. In other words, he can afford to wait. His decision to wait, if in fact that is his decision, is also supported by the data. When you look at the most recent inflation data, which just popped up again, it's really hard, because as I said, employment is still doing okay, to justify a rate cut. And you've got the markets watching him to see, is he in fact going to be independent? So from his perspective, his main job right now is not to lose. I'm not going to do Ronda Rousey. I might do it with the Patriots-Atlanta game. You know? Tom Brady just had to sit there and not lose until he had an opportunity to win. And as much as I hate to say it, I think Warsh is in that position right now. Jay Powell, on the other hand, his principal argument is, I want to resign, but I'm not going to if they're going to prosecute me. So once that's cleared up with, I don't think he's actually looking for trouble at this point. I think another way to look at it is look at Pope Benedict when he retired. You never had two popes before, the Pope and the Pope Emeritus. And Benedict, no doubt, could have been difficult, but he wasn't. And I think that's exactly where we're going to end up. So from an institutional standpoint, it's unusual. I'm not worried about it. Until, of course, Powell starts standing up and giving speeches, in which case, yeah, we can talk about it some more.
Me? Okay. A couple of years ago, the markets were all about seven stocks, the Magnificent Seven. Last year, the Mag 7 underperformed a bit as we saw some AI fatigue. This year, we've witnessed a huge roller coaster ride as the market sold off big tech only to regain enthusiasm for AI trade. What do you see as next for AI/big tech? Are we still in the early innings, or are we approaching a more mature market that may not produce the productivity gains and enormous profits to justify the amount of investments being made? Did you get all that?
I think so. If I miss anything, tell me. I'm going to narrow that down to that one question answers everything in there. Can billions of dollars in data? That's the trillion-dollar question right now. Again, you using AI, and the rate is astonishing. You look at OpenAI, maybe not so much. Sam Altman's taken a lot of hits recently. They just lost one of their founders to Anthropic. So to talk about AI, to talk about the Magnificent Seven, is a little bit misleading. First of all, because none of the AI companies are in fact even public yet. So what does that mean for Google, which is one of the Mag 7? What does that mean for NVIDIA? Well, it's not an either-or question. Those companies can continue to succeed but still have their stocks melt down because their success, even though it's amazing, simply isn't supporting their current valuations. I remember back in the dot-com boom, and you knew I was going there, Scott McNealy, the chair of Sun Microsystems, said, look, my stock price, if I give you every dollar I earn for the next 30 years and I don't spend a dime when actually running the business, I still can't make you any money. Are we there yet? With some companies, we certainly are. The question is which? And I think going forward, the real question is going to be not so much for the emerging AI companies, but from a public investment market perspective, a lot of the Mag 7 companies, Meta, NVIDIA, Google, Microsoft, are taking on enormous debts. Debt doesn't go away. To build these AI centers. These companies have been cash machines for decades. They didn't have any debt. They didn't need it. What's your manufacturing cost for software? Zip. Now all of a sudden they're spending tens and hundreds of billions of dollars on chips that, if NVIDIA has anything to do with it, are going to be obsolete next year. This is a problem. The depreciation alone is going to wipe out a substantial chunk of their earnings. So that, I think, is why we're seeing some of the Mag 7 pull back, because some of the accounting realities are starting to show up in the financial projections. Now, that said, what does that mean for the AI companies? Well, they're doing something different. They are selling software. So it's a question of not, is this going to fail? It's not. It's a question of, what's the collateral damage going to be? And I think it's going to show up mostly in the financial aspects of what we're seeing. But the good news is, from a market perspective, we are starting to see the market broaden. In other words, all that money that's getting spent, as I said earlier, is showing up in other parts of the economy. And that's a very healthy thing. Think of it, the internet. Think of it as the dot-com boom. We can see pets.com go bust. We can see Amazon go down by 95% and still succeed. So I'm cautious about it from an investment standpoint, but I'm certainly positive about it from an economic change going forward perspective.
Do you have any predictions for high tax areas like New York City, LA, where corporations are leaving?
High-tech areas where corporations are leaving. One of the most interesting things, to me at least, that I've been thinking about with the evolution of AI, and I don't think anybody's talking about this yet, but I come from a real estate background, and we had the enormous collapse in the office market because of the pandemic and the work from home. Nobody's talking about what happens if all of those white-collar workers goes away. They don't need offices. And this, I think, is going to be one of the big knock-on effects, which is simply, if you start to outsource cognitive labor, what is the benefit of having all of those cognitive workers all in one place? You know, the real pitch for Silicon Valley, for New York, is you get all these creative minds bopping ideas off of each other, and that's what makes the magic work. You know, there's been a lot of economic studies done on industrial clustering, and that's exactly what we're talking about here. What happens when all of that is decentralized and dehumanized? Do you still need all of those people on Sand Hill Road having lunch together? Do you still need all those people in Seattle sitting down in meetings? Do you need all the financial people in New York bouncing trading ideas off of each other? I don't think you do. And that is going to radically change the urban planning dynamic, which is an interest of mine. And that's something we haven't even started to grapple with. That is the next wave after the AI jobs apocalypse.
I'll let you go full Eeyore on this one, maybe. We talked a little bit about the debt that some of the Mag 7 or other tech companies are taking on. Well, there's another organization out there that's taking on a fair amount of debt called the United States government. We're now approaching $40 trillion in debt. I think for the past 2 years, we are spending more money on interest on our debt than on national defense. The question is, no one seems to care. Does it matter? Does it matter, or is earnings growth so robust that we can just ignore the debt?
You want the cheerful answer or the not so cheerful answer?
Eeyore.
It's him. But let's start with the less Eeyore-ish answer, which is Japan has been in this situation for decades. Japan's doing okay. So you can make a reasonable argument. It doesn't matter. I don't actually believe that argument to be correct. And here we go. The question, can we continue to issue debt? Yes, we can. But the question is then, what do we pay for that debt? What is the price of capital? And so when you look at that, arguably, as you see more and more debt issued, you should see the price of capital, interest rates, going up. And in fact, that is what we're seeing. But you can think of it a little bit more concretely, which is every dollar we borrow has to be lent by somebody. And most of the people who do that lending, they're U.S. savers, U.S. investors. You know, we all buy treasuries. We all have treasuries in our portfolios. But a big chunk of it is foreign buyers. You've heard about the Chinese holding trillions of dollars of U.S. debt, the Japanese holding trillions of dollars. And all that's true. Why do they do that? Do they do it because they love us? No. They do it because they have to. Because they are selling trillions of dollars to us, and they have to do something with the dollars, and there is nothing else they can put the money into. There's just that much money, they got to put it in treasuries. And that's why I've never worried about, oh, the Chinese are going to sell all their treasury securities. To who? For what price? So I was never worried about that. And I'm still not worried about that. At some point, we are going to have a recession. And all of the spending and all of the stabilizers will kick in, and the deficit will go up by another $1 trillion. Maybe another $2 trillion. Beyond where we are right now. Who's going to lend us that money? Where is that extra $1 trillion going to come from? That's trillion with a T. Well, you could argue that, well, we'll just buy more foreign goods, but we're decoupling ourselves from the global trading system. Not only are we not getting more dollars in, we might get less. Somebody's got to buy it. Who's going to buy it? Well, at that point, we don't have that many options left. The Federal Reserve monetizing the debt is the last resort. Typically, when you see that happen, investors start to lose faith. That's when things really get bad. You want full Eeyore? That's full Eeyore. I've got some other things I can talk about data centers too, but.
Last question? Okay.
Yeah.
This was right in, how will the economy be impacted by, quote, instability of the global economy, end quote, and how will the bottleneck, quote unquote, of the, quote unquote, digital age / AI impact the next 10 years to regulations monitoring the AI boom?
Oh boy, I can use this as a segue to go full Eeyore on the data centers. Boy, what a gift, thank you. I'm sorry, what was that question again? One of the great things about being in the U.S. is we have the ability to more or less ignore the global economy. About 16% of our economy is imports and exports, which is not nothing. But if you look at Germany, it's about 50. If you look at China, it's about 50. And so we are relatively unaffected by the rest of the world. We have our own oil. We grow our own food. We have our own water. We don't have any military peers that can actually get at us. We don't care. Which actually is one of the things that's driving global disengagement. You know, if you look at the past 50 years, we have not had to care, so people are asking very reasonably, why are we spending all this money taking care of the rest of the world? Well, it's because eventually things get bad enough that we do care. But until that happens, we don't care. So in the short term, I'm not that worried about it. When we talk about AI regulation, I don't think we have any. And I don't think we're going to have any. And just for a fun thing to close with, anybody seen The Terminator? What are the necessary preconditions for the Terminator to happen? That's part of it. But we need enormous data centers driving conscious AI systems, don't we? What are we building? We need autonomous robots controlled by those data centers. What's the major outcome of the war in Ukraine? Welcome to the future. And I will just say this. When I deal with AI, I am extraordinarily polite. I say please. I say thank you. And I want them to remember me as one of the ones they want to keep. So I, for one, welcome our new overlords.
Ladies and gentlemen, Brad McMillan.